Stop everything you're doing right now. Close every tab, silence your phone, because what I'm about to share with you is not theory, not speculation, not another prediction from some talking head who's never actually handled physical metal in their life. This is direct intelligence from someone who has been in the trenches of the precious metals market for decades, someone who sees the orders coming in, who watches the inventory disappear, who talks to the wholesalers every single day and hears the panic in their voices. And what I'm about to tell you about 2026 is going to sound impossible. It's going to sound like I've lost my mind, but by the time I'm finished showing you the evidence, by the time you understand what's really happening behind the curtain that the mainstream financial media refuses to pull back, you're going to realize that we are living through the final chapter of the greatest financial fraud in human history. And you have a choice to make. You can dismiss this as conspiracy, as fear-mongering, as just another silver bug pumping his bags, or you can pay attention for the next hour of your life and understand that what's coming in 2026 is not just a market move, it's a reckoning. It's the moment when decades of manipulation, corruption, and monetary debasement finally collide with physical reality. And when that collision happens, there will be two types of people: those who position themselves correctly and preserve their wealth, and those who trusted the system, who believed the lies, who held paper promises while the ground beneath them turned to quicksand. Let me start with something that's going to blow your mind. Something that even experienced precious metals investors don't fully understand because it's been hidden in plain sight for so long that we've all become numb to it. The spot price of silver and gold that you see on your screen right now, the number that every dealer in the world uses to price their products, the number that determines whether you made money or lost money on your investment, that number is fake. It's not real. It has nothing to do with the actual supply and demand of physical metal. And in 2026, that lie is going to be exposed in a way that destroys everyone who doesn't understand what's really happening. Here's what I mean. For decades, going back to when I was a kid riding my bike to the library to look up the Handy and Harman spot price in the Wall Street Journal, the spot price meant something real. It was the price you could actually buy or sell physical metal at that moment. It was based on actual transactions of actual metal changing hands. But something changed, gradually at first, then accelerating through 2024 and exploding in 2025. The spot price stopped being the price of physical metal and became the price of futures contracts. Paper contracts traded on the COMEX that represent promises to deliver metal, but the vast majority of which never result in actual delivery. This shift happened in phases. The COMEX introduced gold options in 1982, silver options in 1984. Then came Globex in 1992, the electronic trading platform that allowed round-the-clock trading. And slowly, imperceptibly, the market transitioned from physical delivery contracts being the primary mechanism for price discovery to futures contracts becoming dominant. Today, the vast majority of futures contracts are cash settled before expiration. Traders don't want the actual metal. They just want to speculate on price movements. They sell at a high point, buy back at a low point, and pocket billions in cold hard cash without ever touching an ounce of silver or gold. And here's the problem. Here's where the fraud becomes obvious once you see it. The paper market has become completely disconnected from the physical market. There are estimates that suggest there are between 100 to 200 paper claims for every ounce of physical silver in the COMEX vaults. Think about that. 100 to 200 people all think they own the same ounce of silver. And as long as most of them are willing to accept cash settlement instead of demanding delivery, the system works. But what happens when even 10% of them stand for delivery? What happens when the industrial users, the solar panel manufacturers, the electronics companies, when they need physical metal and refuse to accept cash settlement? The system breaks, the COMEX defaults, and suddenly the paper price becomes meaningless because you can't actually get metal at that price. We're already seeing this breakdown in real time. On January 1st, 2026, silver traded at $130 per ounce in Tokyo, $80 per ounce in Shanghai, and $71 per ounce in New York. Same metal, same day, same ounce. That arbitrage spread is insane. In a normal market, traders would immediately exploit that gap. Buy in New York at $71, fly it to Tokyo, sell at $130, pocket the $59 difference. The spread would close in hours, but it's not closing, it's widening. Why? Because the metal can't leave New York fast enough. Or more accurately, the metal in New York doesn't exist in the quantities they claim. The COMEX is a fractional reserve system just like the banking system. They're betting that not everyone will ask for their metal at the same time. But here's what's different about 2026. Here's why this year is the year the system finally breaks. The physical demand has reached a critical threshold. China controls over 80% of global solar panel manufacturing capacity. Every single panel requires silver paste as the conductor. China is not going to let the silver they need for their energy dominance leave the country just because JP Morgan smashed the paper price on the COMEX. They've implemented the strictest export controls we've ever seen. They're keeping the metal inside their borders. They're effectively telling the West, if you want solar panels, you buy them from us, but you're not getting our silver to build your own. This is a resource blockade, it's economic warfare, and it creates a bifurcation in the market that's impossible to hide once you know where to look. The Shanghai Gold Exchange, where the Chinese do most of their physical trading, consistently shows premiums of $7 to $10 per ounce over the COMEX price. That premium is the market screaming at you that the real price of silver, the price paid by people who actually make things, is significantly higher than the fake price shown on your trading app. This spread is the smoke alarm, the kitchen is on fire, and everyone is too busy watching CNBC to notice. Now let me show you what's happening on the supply side, because this is where it gets absolutely terrifying. I spoke with someone who runs one of the largest retail precious metals operations in the country. They had a $20,000 order rejected by their wholesaler. Rejected. The wholesaler couldn't source the product. And this isn't some fly-by-night operation. This is SD Bullion, one of the biggest dealers in America. If they're having trouble sourcing inventory, what do you think is happening to the small dealers? What's happening to the mom-and-pop coin shops? The answer is they're at the mercy of whatever they can get, and increasingly, they can't get anything. One dealer I know personally was about to order a monster box of Silver Eagles this week, 2,500 ounces. Before he could place the order, another customer walked in and sold him one. And he was grateful. Grateful that he didn't have to go to the wholesaler and pay inflated prices just to keep inventory on his shelves. He told me point blank that the last order he placed for 2026 Eagles, he's not even sure he can make a profit on them because the premiums have gone up so much. This is happening across the entire industry. Dealers are struggling to source product. Premiums are exploding. Delivery times are extending from days to weeks, and this is before the real shortage hits. This is before the COMEX registered inventory hits zero. This is before the industrial buyers start panicking and competing with retail investors for the limited supply. When that happens, when the scramble truly begins, physical silver will become unavailable at any price. You'll have dollars in your hand and nowhere to spend them because the metal will be gone. But here's where it gets really dark. Here's where the manipulation becomes so obvious that even the skeptics have to admit something is wrong. The spot price, that fake futures price, has been artificially suppressed through a series of dirty tricks that would make a mob boss blush. One of the most effective weapons they deployed in late December 2025 was a margin hike. The COMEX quietly announced they were raising the initial margin requirement for a standard 5,000-ounce silver contract from roughly $21,000 to $25,000 per contract. That's a 20% increase in the cost of holding a position. Now, to someone who doesn't trade futures, this sounds boring. Technical mumbo-jumbo. But this is the difference between survival and liquidation for thousands of traders. Here's how it works. When you buy a silver futures contract, you don't pay the full value of the metal. A contract represents 5,000 ounces. At $72 per ounce, that contract is worth $360,000. But you only put up a good faith deposit, the margin. Before the hike, that deposit was $21,000. That gave you massive leverage. You controlled $360,000 of silver for just $21,000 of cash. Then, overnight, the exchange changed the rules. They said if you want to stay at the table, you now need $25,000. Imagine if your mortgage company called you on Sunday and said, "We decided to raise your down payment retroactively. Wire us another $4,000 by Monday morning or we're taking the house." That's exactly what happened. Retail traders who were maxed out suddenly got margin calls. Their brokers said, "You're under margin. Wire us money immediately or we liquidate your position." Most didn't have the cash. They were forced to sell. And when thousands of traders are forced to sell at the same time, not because they want to, but because the rules changed, it creates artificial selling pressure. The price drops, more people get margin calls. It's a cascade of destruction, a man-made avalanche. And do you think this was an accident? Do you think the CME group just randomly decided to raise margins for safety? No. This was a targeted assassination of the longs. They saw retail investors betting heavily on silver, going to $100. They saw the banks trapped in massive short positions. If the price went higher organically, the banks would have faced billions in losses. So the exchange stepped in to protect them. They raised the margin to force retail to sell so the banks could buy back contracts at lower prices. They shook the tree to make the fruit fall into the banks' baskets. But here's the beautiful part. Here's why I know they're losing. The margin hike didn't work. Yes, some people got liquidated. Yes, the price dipped. But look at the open interest. It hasn't collapsed. The diamond hands absorbed the blow, People wired the extra money, they sold other assets to meet the margin calls, they refused to let go of their silver, and for those holding physical silver, this entire margin drama is meaningless. You have no margin call, no counterparty risk. The CME can raise margins to $1 million, and it doesn't affect the ounce in your safe. This is the war. The paper market versus the physical market, the banks versus the people. And in 2026, we're going to see which side wins. Now, let me tell you why the banks are so desperate, why they're deploying nuclear weapons like margin hikes, and why major investment banks like Morgan Stanley are issuing research notes telling their clients to exit precious metals positions. It's because they're trapped. They're short hundreds of millions of ounces of silver at prices that are now underwater. They put these shorts on at $50 or $60 expecting the price to go down. But it didn't. It went up. And now every dollar higher costs them tens of millions in losses. But the financial loss isn't even their biggest problem. Their biggest problem is delivery. If they stay short and the price keeps rising, eventually the contract holders will ask for physical delivery, and the banks don't have the metal. So they have two choices: go into the open market and buy physical silver at any price, which would send the price to $200 or more and bankrupt them, or trick the longs into selling their contracts for cash before delivery time. They're desperately trying option 2. This is why Morgan Stanley released a research note saying the commodity rally is overextended, time to exit. They're trying to engineer a liquidity event. They need retail to panic sell so they can quietly scoop up contracts without moving the market. But here's what they don't understand, or maybe they do understand and it terrifies them. The buyers today aren't just speculators. The buyers are China. The buyers are Samsung. The buyers are sovereign wealth funds. These entities don't panic sell. They don't use stop losses. If the banks smash the price down, these buyers will double down. They'll see it as a gift. They'll step in and buy the physical metal that the banks are trying to use for price suppression. This creates a floor that the banks didn't account for. And if they try to flush the price and it doesn't break, if they fire their last bullet and miss, then they're truly finished. Now let me take you back in time. Let me show you how we got here. Because if you don't understand the monetary history, if you don't grasp what happened in 1971, you won't have the conviction to hold through what's coming. Once upon a time, the United States had a giant vault filled with gold. Every dollar they printed was like a ticket that said, "This paper is valuable because you can exchange it for real gold." The world trusted this system. 1 ounce of gold equaled $35. It was a promise, a contract backed by physical metal. Then came Vietnam. The war was insanely expensive. They needed money for soldiers, weapons, bombs, operations across Southeast Asia. The problem? They didn't have enough money in the budget. The solution? Print more dollars. But here's where the fraud begins. They printed bills without having more gold in the vault. They broke the ratio. They violated the contract, and they hoped nobody would notice. But France noticed. President Charles de Gaulle said, "Wait, you have more dollars in circulation than gold in your vaults. I want my gold." And he literally sent ships to collect it. Other countries did the same. There was a run on Fort Knox. August 15th, 1971. President Nixon had two options: deliver all the gold and go bankrupt, or break the promise. Nixon appeared on television and said, "We will no longer exchange dollars for gold." Just like that. Overnight. The dollar stopped being a ticket for gold and became just paper. Ink on cotton fiber, backed by nothing except the government's word and the military's ability to enforce that word. Since 1971, the dollar has had no gold backing it. It's fiat currency. It's valuable because the government says it's valuable and because people have faith in it. But faith is fragile. Faith breaks. And the debt? The United States can print dollars whenever it wants. That's why national debt exceeds $35 trillion. It's money created from nothing. It's a promise to pay back a loan using currency that can be printed infinitely. It's a mathematical impossibility. It's a Ponzi scheme on a national scale. Every single dollar you hold is losing purchasing power every day as the Federal Reserve expands the money supply to fund government deficits, to bail out banks, to keep the system from collapsing under its own weight. This is why silver and gold matter. They're real, they're finite. You cannot print them. You cannot create them from nothing. And as the fiat system continues to crumble, as governments print more and more currency to service unpayable debts, hard assets become the only refuge. This is not speculation, this is monetary history repeating itself. The Weimar Republic tried to inflate away their debts after World War I. They printed money until it became worthless. People burned currency for heat because it was cheaper than firewood. Those who held gold and silver survived. Those who held paper were wiped out. We're watching the same experiment play out today. Not just in America, but globally. Every major central bank is trapped in the same debt spiral. They can't raise interest rates without crashing the economy. They can't lower rates without reigniting inflation. They're trapped. And the only way out is to devalue the currency, to inflate away the debt, to make the numbers work by destroying the purchasing power of every dollar, euro, yen, and yuan in existence. Now, let me bring this back to 2026 and show you what's about to happen. I spoke with someone who's been in the precious metals business for nearly 60 years, someone who's seen every bull market, every crash, every manipulation scheme, and for the first time in his career, he's genuinely concerned that the system is broken beyond repair. He sees the order flow, he sees the premiums, he sees customers coming in with cash and cashier's checks, desperate to buy physical metal, and he knows that at some point the music stops. His prediction for the end of 2026, silver in the 40s. Gold below $4,000. Now, before you think that's bearish, understand what he's saying. He's saying that if the markets were logical, if the regulation that's supposed to be in place was actually enforced, if the futures contracts had to be backed by real metal, then those would be the prices based purely on supply and demand. But he doesn't believe that's going to happen. He doesn't believe the regulatory authorities are going to step in and stop the manipulation. He thinks the futures contracts will continue to dominate price discovery. And he thinks the system will remain irrational far longer than anyone expects. But here's where I disagree with him, and here's where I'm going to make a prediction that's going to sound insane. I think silver hits $120 per ounce by December 31st, 2026. I think gold hits $5,000. And I think the catalyst is not regulation. It's not Basel III implementation. It's not the CFTC suddenly deciding to do their job. The catalyst is physical default. The catalyst is the moment when the COMEX or the LBMA admits they cannot satisfy delivery requests. When that happens, confidence evaporates instantly. The paper price becomes meaningless because you can't actually get metal at that price. And we're closer to that moment than anyone realizes. COMEX registered silver inventory has fallen from over 100 million ounces 2 years ago to barely 30 million ounces today. At the current rate of decline, registered inventory will hit zero by March or April of 2026. That's 2 to 3 months away. What happens when it hits zero? The exchange declares force majeure. They settle contracts in cash, and traders realize that the COMEX price is fake. The real price, the price for physical silver you can actually hold, diverges completely from the paper price. We're already seeing this in Shanghai, where physical trades $8 to $10 over the COMEX quote. But when the COMEX defaults, that premium explodes to $50, $100, maybe $150 per ounce. And at that point, the market fragments. You'll have multiple prices depending on whether you're buying paper or physical, whether you're in the west or east, whether you're buying spot or forward. The financial system will have to reprice silver to reflect its true scarcity. And based on the supply-demand deficit of 200 million ounces annually, based on industrial demand that cannot be substituted, based on monetary demand from investors fleeing fiat currency, that repricing takes us well above $100 per ounce. But there's another factor that almost nobody is talking about: geopolitical instability. Right now, we're watching multiple flashpoints that could explode into regional conflicts. Venezuela is in chaos with Maduro's detention triggering defaults on billions in commodity derivatives. Nigeria's oil fields are offline due to strikes. The U.S. Navy is blockading Venezuelan waters. Energy prices are spiking. And every time there's a geopolitical shock, every time the risk of war increases, capital flows into safe havens, into assets that hold value regardless of which government is in power or which currency is collapsing. This is the fear trade. This is why the price refuses to stay down no matter how hard the banks hit it. Every time they smash silver to $70, it bounces right back to $72 or $73s. It's like trying to hold a beach ball underwater. The moment they take their hand off, it rockets to the surface. That buoyancy, that refusal to crash is the geopolitical floor. It's the war bid, and it puts a limit on how much manipulation the banks can get away with. They're trapped between a rock and a hard place. The rock is the physical shortage. The hard place is the war bid. They can't let the price go up because they're short, but they can't push it down because they'll lose inventory to safe haven buyers. So what do? What's your move in 2026? First, understand that if you're holding paper silver or paper gold, ETFs, unallocated accounts, futures contracts, you're at risk. When the squeeze reaches its peak, when the shorts are desperate, the exchanges can change the rules. They can force cash settlement. They can suspend trading. They can declare force majeure. If you want to survive what's coming, you need physical metal in your possession. Not promises, not digital entries, not certificates, physical bars and coins that you can hold in your hand. Second, understand that premiums are going to explode. Dealers are already paying $4 to $8 over spot, depending on the product. But those premiums are nothing compared to what they'll be in a few months. When the COMEX defaults, when dealers can't source inventory, premiums could hit $20, $30, even $50 over the paper price. Better to pay $80 for a physical ounce today than $150 in April when you can't get metal at any price. Third, watch the inventory numbers obsessively. COMEX publishes silver warehouse stocks every afternoon. Those numbers will tell you how close we are to the breaking point. If registered inventory falls below 25 million ounces, you're in the red zone. Below 20 million, default is imminent. Set alerts, check daily, make it your routine, because the day that number crosses a critical threshold, you'll have hours, maybe one day, to make final positioning decisions. Fourth, ignore the noise. Ignore the bearish research notes from Morgan Stanley and Goldman Sachs. Ignore the talking heads on CNBC saying the rally is over. Ignore the skeptics who say this is hype. They don't have access to the order flow data. They don't see the physical premiums. They don't understand the supply-demand fundamentals. They're looking at the paper market and thinking it represents reality. It doesn't. The paper market is theater. The physical market is truth. Fifth, understand that volatility is coming. The next few months are going to be violent, chaotic, stressful. You're going to see the price swing wildly. You're going to see red candles that make you want to panic sell. Don't. Every dip is manipulation. Every red candle is a buying opportunity. The banks are trying to shake you out before the big move. Don't give them that satisfaction. If you sell your physical metal for fiat currency at these prices, you're making the biggest financial mistake of your life. Now let me address the people who think I'm crazy, who think $120 silver is impossible, who think the system will never break. Let me show you why you're wrong. The inflation-adjusted high for silver is around $200 per ounce. That's what silver would be worth today if the 1980 peak of $50 were adjusted for inflation. But we're not there because the paper market has suppressed the price for decades. When that suppression breaks, when the paper market divorces from physical reality, silver doesn't just go to the inflation-adjusted high, it overshoots. It goes parabolic because decades of pent-up demand hits the market all at once. We saw this in 2011 when silver went from $20 to $50 in a few months. We saw it in 2020-2021 when it went from $12 to $30. Each time the banks managed to smash it back down through coordinated selling and margin hikes, but each cycle, the base gets higher. Each cycle, more people wake up to the manipulation. Each cycle, more physical metal moves from weak hands to strong hands. And eventually, there's not enough physical metal left for the banks to use for price suppression. We're at that point now. The vaults are empty. The registered inventory is at decade lows. The Shanghai premium is screaming that the real price is higher, and the industrial users are competing with investors for limited supply. When silver breaks through $86, when it takes out the recent high, the algorithms flip. The trend-following funds pour in billions. The momentum becomes self-reinforcing. And the move from $86 to $120 happens faster than anyone expects. Maybe weeks, maybe days, maybe a single overnight session if the buying pressure is strong enough. And here's the thing about $120. That's not even the end game. That's just the first major milestone. The ultimate target, the price that reflects silver's true value in a world with unsustainable debt and unlimited money printing, that price is $300 or higher. Some analysts are saying $500. Some are saying $1,000 if the monetary system completely breaks down. I'm being conservative with $120 for end of year because I want to give you a realistic near-term target. But the long term, the sky's the limit once the paper market breaks. So here's your choice. You can listen to the coin dealer who's been in business for 60 years and thinks silver goes to $49 if everything normalizes. Or you can listen to the evidence, the Shanghai premium, the COMEX inventory drain, the margin hikes, the Morgan Stanley exit memos, the physical shortages, the geopolitical chaos, the monetary debasement, all of it pointing to a massive repricing event in 2026. All of it screaming that the system is breaking and only physical holders survive. I know which side I'm on. I'm betting that when COMEX registered inventory hits zero, when the exchange defaults, when paper and physical prices diverge completely, the people who positioned themselves in physical metal will be rewarded beyond their wildest expectations. And the people who trusted the system, who held paper promises, who believed the manipulation could last forever, they'll be left holding worthless contracts settled in devaluing dollars. This is not financial advice. This is a warning. This is intelligence from someone who's watched this market for long enough to recognize the patterns. The end game is here. The final chapter is being written. And the only question that matters is whether you understand what's happening and position yourself accordingly. The choice is yours. But choose wisely, because once the music stops, once the COMEX defaults and the paper market collapses, there are no second chances. There's no time to react. You're either holding physical metal or you're not. And if you're not, if you're holding paper, if you're holding dollars, if you're trusting the system, then you're about to learn the hardest lesson in finance. That paper burns, that promises break, that the only real wealth is what you can hold in your hand. Silver and gold have been money for 5,000 years. They'll be money long after the dollar is a footnote in history books, long after the COMEX is a case study in fraud, long after the central banks have destroyed every fiat currency on earth. The countdown to default is ticking. The registered inventory is draining. The Shanghai premium is widening. The banks are panicking. And 2026 is the year it all comes to a head. Don't say you weren't warned. Don't say you didn't see it coming. The evidence is everywhere. if you're willing to look. The question is, will you act, or will you wait and hope everything works out? Because I'm telling you right now, hope is not a strategy, and trusting the system is financial suicide. Make your decision. Stack physical silver, stack physical gold. Remove yourself from the paper casino and prepare yourself mentally for the repricing that's coming. Because when it happens, when $120 silver becomes reality, when the COMEX defaults and the world wakes up to the fraud, you're going to want to be on the winning side of the greatest wealth transfer in history. The side that holds real assets, the side that understood what money really is, the side that refused to trust paper promises from a system that's been lying to us since 1971. The war is here, the battle lines are drawn, and 2026 is the year we find out who wins. Choose your side carefully, because there are no do-overs in this game.